This was supposed to be the year rates came down. The Bank of England cut rates 5 times. Prices in London were coming down. Mortgage deals dropped below 4% for the first time in years. For buyers who had been waiting, everything was finally moving in the right direction. In 2 weeks, the mortgage market moved against them. Not gradually. Lenders repriced overnight. Products that existed on Monday were gone by Thursday. The crash is not coming. In parts of this market, it already started, and the move that was supposed to stop it has just made it worse. They did everything they were told to do. They saved the deposit. They watched the rates come down. They waited for prices in London to fall. By the start of this year, nearly 6 in 10 young buyers planning to purchase in 2026 had already set aside what they considered a serious deposit. Barclays confirmed that in February, the conditions they had been waiting for were finally arriving. And then the market moved against them, again. In January, mortgage deals dropped below 4% for the first time since 2022. Sellers were coming back to the market in numbers not seen in a decade. Zoopla confirmed that February was on track for the highest monthly new listings in 10 years. Buyers were moving. Sales were running at some of the strongest February levels in years. For buyers who had spent years being told to wait for rates to fall, wait for prices to drop, wait for conditions to improve, this was the moment. Not in theory, in practice. The deals were there. The listings were there. The borrowing power was there. But even in those improving conditions, the latter had not changed. Rightmove confirmed this month that the gap between what a first-time buyer can afford and the next rung on the property ladder is the biggest it has been since records began. Getting onto the first rung was becoming possible. Getting to the second from there required more than half as much again. In London, the gap was even wider. The conditions improved, the structure did not. And then the conflict started, and the conditions the buyer had been building toward changed in a week. Sellers in Westminster are not getting offers. The ones who do are being asked to cut. The ones who refuse are watching their listings sit on the market for months. The buyers who were supposed to arrive at lower prices are not arriving because the mortgage those lower prices require just got more expensive. Westminster has lost more than a quarter of its value since the start of 2023. Land Registry data cited by the Homeowners Alliance this month. In a single year to December 2025 alone, £154,000 was removed from the average property. Not a valuation estimate. Completed sales. Think about what £154,000 means for a buyer. That is a deposit. That is years of saving, removed from the price while the buyer was watching and waiting. And yet the buyers who were supposed to step in at those lower prices are still being priced out not by the property, by the mortgage they would need to buy it. New build flat sellers in London are selling at a loss. Over 40% of them did in 2025, according to Hamptons and Land Registry data published this year. The average seller who made a loss had owned their property for almost 9 years. 9 years of ownership, still sold at a loss. Kensington and Chelsea, Camden, Tower Hamlets, 5 central London boroughs, all recording double-digit annual falls from the same ONS dataset, the same 12-month period. The damage is not a Westminster problem, it is moving outward. Prices fell, and then the mortgage that was supposed to let buyers act on those lower prices got more expensive. The window opened, and then it closed, in the same month. Nationwide repriced overnight. NatWest moved its rates in a single announcement. Halifax followed. HSBC announced increases effective the 23rd of March. Santander followed. Virgin Money followed. By the end of the week, there was not a single major lender that had not moved. That is not one lender responding to market conditions. That is the entire market moving at once, and it moved faster than buyers could react. Around 1/5 of all available mortgage products were pulled from the market in days. Adam French at Moneyfacts confirmed that figure on the 21st of March. Deals that existed on a Monday were gone by Thursday. Not repriced, gone. If you had an offer accepted last week and were expecting to lock in your mortgage this week, your lender is offering something different now, on different terms, at a different cost. The product you were approved for may no longer exist at the price you modeled. This is not a warning about a possible future. This is what is happening in the market today. At the start of this month, the cheapest deals on the market were the most competitive seen since before the rate rises began. Buyers who had been watching for exactly this moment saw them. Some moved. The ones who had not yet moved are now looking at a market where those deals no longer exist. David Hollingworth at L&C described it on the 19th of March as a bumpy ride for borrowers, adding that a deal available today is not guaranteed to be there tomorrow. Not a prediction. A description of what is already happening. And this is not the first time something was taken from buyers without warning. This one happened overnight. The last one happened in a budget. On the 1st of April 2025, Rachel Reeves cut the stamp duty protection that first-time buyers had been depending on. Before that date, a first-time buyer purchasing at £425,000 paid nothing in stamp duty. After it, they paid £8,750. The property did not change. Their income did not change. A decision was made in a budget document and it reached into their purchase and removed £8,750 from their plan. Before that change, 79% of first-time buyers paid no stamp duty at all. After it, that fell to just over half. Not because prices rose, because the threshold was cut. Stamp duty hits the deposit. The rate move hits the monthly payment. Both happened within 12 months. Both working against the same buyer, neither reversed. The budget you built for this purchase a year ago is not the budget you are working with today. Two decisions, neither of them yours. Rachel Reeves moved the threshold. Then, the mortgage market moved. The buyer sitting in the middle of both had no say in either. The threshold was a political decision made in a budget. The rate move was the consequence of a conflict the buyer had no part in. Both happened to them. Neither happened because of them. And the buyer who thought moving further out would solve it is about to find out why that has not worked either. Sellers in Crawley and High Wycombe are watching the same thing Westminster sellers watched a year ago. The offers are getting smaller. The time on market is getting longer. The buyers who were supposed to arrive have not shown up. Both towns were already recording annual price falls before this month's rate shock arrived, according to Lloyd's Bank data from October 2025. The problem was running in the commuter belt before a single lender repriced this week. These are not London postcodes. These are the places buyers moved to when London became unaffordable, and they are falling for the same reason London is falling. Prices too far above what local people earn. Buyer pools too thin. No room left for rates to move without removing the buyers who were barely qualifying in the first place. The first-time buyer who could just stretch to a commuter belt town before this month cannot stretch now. That is not a small number of people. That is an entire cohort of buyers at the margin of affordability in the Southeast, and in a market that was already fragile, removing them does not slow the fall. It accelerates it. The markets of first-time buyer might actually be able to reach Scotland. The North are the ones still growing, according to Zoopla. The markets they were trying to get into are the ones falling. The market is not correcting toward the buyer. It is splitting away from them. And the buyers being removed from those falling markets are not coming back, because the mortgage that would have brought them back was repriced this week. Before the conflict started, the Bank of England was expected to cut rates at its March meeting. Markets had priced that cut at 80% probability, according to economists at ING. Buyers who had been modeling their affordability around improving conditions through 2026 were not being naive. They were reading the market correctly as it stood in January. The bank held at 3.75% on the 19th of March, unanimous. Not because of anything happening in the UK economy, not because domestic inflation surged, because of a war nobody predicted in January when buyers were running their numbers. Before the conflict, the direction of travel was clear. Rates falling, affordability improving. The buyer who had been patient finally getting the conditions they needed. Traders are now pricing in the possibility of rate hikes this year, not cuts. The Homeowners Alliance confirmed that this week. The direction of travel reversed inside a month. The rate environment buyers were planning around does not exist anymore. It was replaced by a different one while they were waiting to act. More fixed-rate mortgage deals are expiring this year than there are people living in Birmingham and Manchester combined. Every one of those borrowers was planning around a rate environment that no longer exists. The ones who were going to use the move to free up a property for a buyer below them in the chain are now staying put. The sellers who were depending on them have lost them. The first-time buyer at the bottom of that chain has lost their route in. That is not an abstract chain reaction. That is a specific buyer probably watching this who saved the deposit, ran the numbers, waited for the right moment, and is now looking at a market that shifted while they were preparing to enter it. That is not bad luck. That is a pattern, and it has a cause. They did everything right. Saved the deposit, watched the rates, waited for prices to fall, and then the bank held, the threshold moved, and the products disappeared. If you have an offer in or were planning to make one this spring, the rate that was available when you modeled your monthly payment is not the rate available today. Model it at the current rate before you commit. If the numbers only worked before this week, they do not work now. The seller in a market that has been falling for a year has less leverage than they think. Use that before you sign anything. If you have been watching and waiting for prices to fall far enough, the fall is happening in the places that were most expensive. The problem is, the mortgage those lower prices require now costs more to service than it did when the prices were higher. The window moved. And it did not move in your direction. The price came down. The monthly payment went up. The net position has not improved. It has shifted. That is the thing nobody is saying plainly. Falling prices and rising rates are not a recovery for buyers. They are a different version of the same problem. Affordability is not just about what the property costs. It is about what the mortgage costs. And the mortgage just got more expensive. They promised buyers that if they waited long enough, the market would come to them. It did. And then the Bank of England held. Rachel Reeves cut the threshold, and a war in Iran sent rates the wrong way, and the window closed before anyone could get through it. Subscribe. The situation is developing, and the numbers are not what you were told to expect.